So gents, today's episode, we've got Tony Mullan who's coming on from Greenacres.
Probably a HMO. You're spreading your risk. If you've got one buy-to-let, for instance, that's one payment. If your tenant fails to make that payment, that's it. That's your one kind of income. Whereas if you've got a HMO where you've got maybe 6 to 9 people paying you money, if one fails to make that payment, you've still got the other rate, the other 5. So it's less riskier, in my opinion, for HMO.
He's a specialist broker there, and we're going to just touch this episode on everything going on with cost of living. Obviously, inflation's up to 9% as reported in the recent couple of weeks, and really just pick his brains on what's going on with trends, mortgages, and touch it around landlords, first-time landlords a little bit as well. But I think Tony doing it day to day, writing mortgages day to day, it would just be an interesting conversation to see how he's finding things, I would say. So, Mike, any specific questions you're going to throw his way?
Yeah, I'm going to do this off the back of a recent pod that Tristan and I filmed, that there's 250,000 less rental properties in the market than there were 4 or 5 years ago. So I just want to know who right now is buying buy-to-lets and why.
Yeah,
Simple as that.
Yeah, because he knows the demographic of people that's buying. So, yeah, looking forward to getting stuck into that. Yourself, Tristan?
It'd be interesting to see what trends are going on. Like you said, we're seeing an increased number of investors out there, working myself specifically, but I know others that are in similar situations, hearing it from a different opinion, that's dealing with it day to day, and a landlord himself, what would he go for if he was to invest in a deal? So, yeah, just like to hear a different opinion of what's going on.
Yeah, and I think for me, it'd be interesting to just put him on the spot with what he sees happening for the rest of the year, really, from just mortgages, cost of living, interest rates, and just find out how mortgage advisors close to the ground with the underwriters, the lenders. So what's he expecting them to do? What movers and shakers are going to happen throughout the year? So shall we get him on?
Just get him on.
Okay, so thanks so much for coming on. We really appreciate you being our first guest in our new office, even though the podcast week isn't quite finished yet. So we're in the lounge. First question as ever to any of our guests. What brought you into property and made you a landlord?
I guess, getting into the property industry, I like dealing with people first and foremost, and helping my clients achieve their kind of dream goals, especially with the mortgage side of things, and obviously with property, it's an investment for long term.
Is that what you kind of thought when you went to become a landlord? You thought long-term investment, and you can kind of put some money into something that's going to make a long-term gain?
Oh yeah, 100%. Yeah, in it for the long term. So 25 years, 30 years plus.
Yeah, we talk a lot on the podcast, don't we, about what people's goals are. Are they long-term equity gains, or are people trying to make cash monthly and then kind of repeat it down the line, or is it a pension plan really? And it's always quite interesting to ask people that question because you get a variety of different reasons. Yours was strategic rather than accidental, though. It was an investment that you planned to make.
Yeah, 100%. I mean, twofold. So you're going to gain on the property, even if property prices just increase by 2% a year.
Yeah.
Over 30 years, you're going to gain on that property value. Plus, if you can make overpayments on the mortgage. So, if you do come into some sort of money or reinvest the money back into the property to reduce, the interest repayments, you're going to gain there as well. And obviously you've got an income, so which you can declare as well.
Yeah, absolutely. So I think on this episode, what we really wanted to touch on, obviously being a mortgage advisor, you see firsthand what lenders are doing, what the underwriters are doing, buyer trends as well, and landlord trends in terms of what type of mortgages they're looking to get. But we wanted to talk about everything going on with cost of living, everything mortgages and market really. So although, yes, we're going to have a lot of conversations that are going to relate to landlords, general podcast chat in terms of market and mortgages. And one of the first things that I read today on, I think it was one of the mortgage news articles actually, was just around this kind of mortgage prison that might be something that people are falling into at the moment. And effectively the article stipulated that if someone's getting quite a high loan to value at the moment, there's a strong chance when the fixed term rate is up, the way criteria is set at the moment with how affordability is likely to sort of get a lot more expensive and therefore a lot more stringent, maybe people are stuck on variables. Is that something that you're kind of talking or advising around at all?
Yeah,
at
I
the
mean,
moment?
it's definitely a conversation that's coming up quite a lot recently, especially with our compliance and the FCA are kind of pushing a lot more on a budget planner for clients to make sure that it is 100% accurate, because we're not only just advising on today's mortgage, we want to make sure it's stressed for that at least the product term and past the product term. So if it's 2 year or 5 year, but generally you want to make sure it's affordable over the whole 25 years,
Yeah, exactly.
or 35 years in some cases. But I guess with regards to this mortgage prisoner kind of phrase, it's it could come under the FCA guidance of vulnerable clients. So making sure that they're treated accordingly to the guidelines effectively.
Well, I think the people that probably most impact are the people that are, for example, I've got a good friend of mine that was talking about upsizing significantly with his family. So, talking about spending 750 grand, fair chunk up. And he was effectively saying, well, I'm going to wait until next month to get the dip done on the mortgage, because there's a couple of bonuses coming in. I think his wife had gone from contractual work to permanent work, and it would mean that he could potentially get another 40-50k. And I just sort of said to him, you might be able to do that now, but think about the affordability as well, because I think sometimes we have a duty of care as people in the property industry to make sure we're giving the right long-term advice as well. And for him, it was a case of he can afford that today, but can he afford it in 3 years? I know when you've spoke to landlords in the past and done budget planning, that's something that at the moment I think we really as property professionals should be explaining to buyers, is it might be very different in 2 or 3 years' time because of things like inflation at 9%, etc. I reckon that's probably not spoken about enough, is it, Mike? I don't think.
Yeah, I think generally speaking, when you buy anything, you look at the here and now. Do I want it? Can I buy it? No one can predict the future, but you can only look at the trends. What's happening right now? What's happened in the last year, and what's likely to happen in the next couple of years? And I think in the last probably 7 years since the mortgage market was reviewed, there's a lot of stress testing involved. And if the landlord or the client or the buyer had a better knowledge of what those stress tests involved, they might be able to plan for themselves a little bit better on, well, my buy to let looks like this now, and if X, Y, and Z happens in 3 years, it will look like that. And a good mortgage broker definitely will be someone who shares that kind of information about why the mortgage lender is stress testing to a certain percentage.
Yeah, definitely. Interesting you mentioned about budget planning, actually, because I think when I started my career in agency, the budget planner almost was a bit of a, does anyone really follow it? It's kind of, it's something you print out and you say, look, do that if you want to do it, but whatever. But now actually I think it's a really good document to kind of base the principle of what the goal setting needs to be before someone goes and buys an investment or a property.
Yeah, and it's you can have the budget planner in a conversation. You can make notes as you're going along. What's the council tax rate of this property, that property, and it doesn't have to be so stringent where you're sitting there filling out a document. Yeah, it's one of our compliance items now that we I've always done it anyway. So, but rather than just send it off to the client, making sure they do it, we have to make sure it's done thoroughly. So.
And what about trends on buy-to-lets? So with mortgages at the moment, how have buy-to-lets sort of evolved over the course of the year with interest rates? And what kind of trends are you seeing with people from a buy-to-let mortgage perspective at the moment?
Yeah, I mean, overall, lending is still cheap.
Yeah.
Considering what it was, February 2009, it's still super low. What stifled the buy-to-let market was obviously the surcharge in the 3%, with the stamp duty. But that has started to pick up, since then. But I haven't seen a slowdown this year at all, and even to today. I did 3 buy-to-lets yesterday, for instance, quite locally to Maidenhead in Berkshire. I haven't seen a slowdown at all.
That's interesting that that's not changed. Good news for obviously yourself, landlord Tristan, for landlords, because I would have worried if it had seen a little bit of a slowdown, because there's a lot more landlords. We talk about more landlords selling than buying at the moment, but we're talking to a lot of active landlords. I mean, I did an open house on Saturday for a classic family home in Bracknell, 3-bed end terrace, 11 viewings, and 3 of them were either doing a let to buy or a buy to let. So, that's best part of a quarter of the viewings were actively looking landlords, which is great news for the market, I think. But that's positive. No real drop in change with the rates slightly creeping up.
Yeah, I mean, it's still super cheap. So it depends on the landlord, obviously. If they take the view that I had, where it was a long-term game, then I don't see why they shouldn't, try and commit now rather than tomorrow, because today is the cheapest day it will ever be. At this current time.
Yeah, it's a phrase we use all the time, isn't it? Cheapest day to buy a house is today.
Yeah.
And I think that will be the same for many days and weeks and months to come.
I think I've stolen that off you.
Take it. If everyone's saying it, it makes a lot of sense, doesn't it? Yeah, use it and abuse it. Happy with that.
Well, now's a time of opportunity, isn't it? With rates being so low, rents up, and obviously the increased demand on that. There was something on one of our other podcasts with Matt saying about be greedy when people are fearful, and be fearful when people are greedy.
Yeah.
And now's the time of opportunity, I'd say, and that's probably why we're seeing more increased of landlords doing let to buys, buy to lets, because there's great opportunities out there, some great gains to be won in property over a long period of time.
100%, because the other side of the coin as well, with if affordability is becoming a lot more difficult for potential buyers, the only other option they can't buy is to rent. So if there's a lack of new buyers to the market, then they have to rent. So the rent is going to increase. So they will potentially get it that way as well. So
yeah, and I think on the flip is, I always say, if all the landlords pull out of the market, it's not like everyone wants to buy a home. Some people want to rent. They want to keep their cash and their equity in a business or in investments, and not necessarily in property. And that lifetime renters, that's a big part of the UK economy for that reason. And also for people that can't stay at home with parents, that want to rent, just to check that if they're going to buy with a new partner or a brother or a sister, that they can actually live together okay for a year or two. Yeah. And if there's much less in terms of properties available to rent, then the price is much higher, which makes the ability for them to get on the ladder much more difficult, because they can't save as much. So I do understand why people get frustrated with landlords, but I also think from a first-time buyer perspective, sometimes it's a little bit short-sighted, because if we have more supply of landlords and buy-to-let properties available to rent, then to rent them is cheaper. It's just simple economics. Yeah. What trends are you expecting to see just overall in the mortgage world? Talking to your colleagues, talking to underwriters, what are you expecting to see over the rest of the year?
So there'll be a lot more to do with first-time buyers. I can see a lot more lenders now, because of the Help to Buy scheme is coming to an end next March, I think it is. So there's going to be a lot more emphasis on first-time buyers to try and get on the property market. So the 95% mortgages, that sort of thing, or a mortgage guarantee. So more influence on that side. There's also a lot more kind of niche lenders, such as, say, Family Building Society, that they specialise in something called joint borrower sole proprietor, which you can purchase a property with, say, me and Mike purchase a property, but you live in it and you'll be on the mortgage as well. But they use our income for you to go on the same application. So there's a lot more of that coming to the market, which I see a few lenders kind of following suit with it.
What end do you expect that to be? Do you expect that to be parents being the you and Mike, child being me living there, or the other way, people of our age bracket that have got good earnings, we'd like to think, but maybe parents that can't get a mortgage but need somewhere and actually they're living in there? Both
ways, because it works. It needs to be, I think, depending on lenders' criteria, but either immediate family. I think it does go outside of immediate family, maybe to cousins. I need to double check the criteria with some lenders, but it could be friends as well that could go on the mortgage, as long as they're obviously they have to, if they're on the mortgage application, they're also responsible for those repayments.
Mm-hmm.
So it's a big ask to ask your mate Bob down the pub.
Yeah. Yeah, might be an error, that one. We'll see. And we were talking off camera about one of the building societies have suggested that they'll do 6.5 times earnings now for remortgages. I'm guessing that's on residential.
Yes, they haven't done anything on the buy-to-let, but it's a remortgage and it's like for like. So that's the important bit. So just say you were with another lender. This particular lender will allow you to switch to them, but increase your borrowing. Mm-hmm. Should your income level have dropped in the past, say 2 or 3 years. Okay. So it's particularly good for someone that was employed that went self-employed, and they then have a choice of another lender rather than their current lender.
It's good that they pulled that into the market, actually, because it does hopefully help people get out of that mortgage prison that we spoke about earlier as well. In terms of going back on the buy-to-lets, the remortgage part for buy-to-let landlords, what advice are you giving to, not necessarily the 3 people you did a buy-to-let for yesterday, but are you expecting them to take longer term fixed? Are people taking trackers for any reason at the moment, or is that a crazy thing to do? What are you expecting most people to do for the rest of the year on the buy-to-lets?
Yeah, I mean it's going to be, the majority of buy-to-lets are predominantly interest only, so that's what they'll take that kind of product out on. But I wouldn't really advise a tracker rate at the moment, because there is, in my opinion, loads of other people have different opinions, but it's not going to go lower.
Yeah,
it potentially could go up a bit more.
Mm-hmm.
So I probably advise against the tracker. So fixing, the best borrowing is 5 years for buy-to-lets, and the remortgage of them.
And who's out there buying buy-to-lets at the moment? Is there a specific type of person? Is it a really narrow demographic of people, or is it just absolutely anyone?
It's absolutely anyone. I've one of the 3 yesterday was a first time landlord, first time buyer. So they're currently renting. So they're buying a property, renting it out, and that's the first time they bought a property. And there's only a few lenders that actually.
I was going to say that's a fascinating subject in itself.
Exactly. There's only a few lenders.
It's something I've absolutely screamed about for probably 10 years. If you live with your parents and earn a good living, but you are on a sole income, so you can't go out and buy the type of flat or house you want, the best way to get on the property ladder is to buy a buy-to-let, and it starts paying you whilst you're living at home. You can use that equity growth to go and actually buy the house you want in 5 years' time. But lenders have traditionally blocked that, right?
They have, being first-time buyers. No, they've got no track record of being a landlord, so that's kind of their risk factor. But there's a few lenders that do it, which is good for someone like me, because I've got over 100 UK lenders that I can actually look at, and I've got 5 or 6 different lenders that are exclusive to us as well. Mm-hmm. Really niche lenders. So. But yeah, one was first time buyer, first time landlord. A second one, he and she taking equity out of their property. They've already got 2 other buy-to-lets, so they've seen an opportunity and they want to jump on it. Mm. And one he's got a portfolio, so a portfolio of 5 different properties. So it is really a mixed bag.
Yeah.
In that sense. So it's really hard to pinpoint who's actually potentially going out and buying all the. For that, really.
Have you typically seen an increase of people buying under limited companies in the last year or so?
Yes.
And do you see that continuing over the next sort of 12 months or so? Is there
potentially? They would need to seek advice from an accountant on that. That's something I can't really give advice on. But there are positives to putting it in a special purpose vehicle, such as that limited company. But I have seen an increase in it. So they're getting good advice, in my opinion.
I think as well with the landlord element of things, it's interesting what you said about family couple, husband and wife. By the sounds of it, that are looking at pulling equity out of their residential home to invest. In this case, they've already got 2 buy-to-lets, so they feel comfortable doing it because they know what they're doing. We're meeting a client tomorrow in here that's looking to do exactly that. They've seen, you know, their house price probably in the last 24 months go up somewhere around 20%. And if you've got a decent 4-bed detached family home, that's a fair chunk of cash that has gone up. So they've thought, right, well, you know, it's less monthly cost at the moment than what it was 24 months ago. We've got 20% more equity. Let's pull 20% out. Doesn't cost us any different, and we've got an investment, especially if you do it on an interest only, an investment that might have a £400 a month mortgage that's making you £1,000 a month, or rent £1,000 a month. You know, you £450 net gain at the end of it. Why wouldn't you do that 2 or 3 times over if you can? So I think we're now potentially going to see that becoming a bit of a trend as people realise we've got a lot of cash in our bank.
Absolutely.
In our property.
It's the perfect
House,
case study,
yeah.
I guess.
Yeah.
Those 3 people.
Yeah.
The first time buy to let person, whoever you are, I love you. I think you're doing the best. It's the best decision you'll ever make. And I think I'd love to go into schools and universities to tell people to do that. The second people, they just understand they've made a potload of money for doing nothing in 2021, 2022. They're probably the poster boys of the COVID era. And rather than go and put a Range Rover on the drive, they're going to add another property for free, because that's what, you know, they won't put any of their own cash in. They'll just take money out of the properties and put another one in the line, which will benefit their family no end. And then the third is your classic buy-to-let, who's just every couple of years just adding another property to the portfolio to make it work. So it's a really good, it's just a perfect example of who's out there buying, why they're doing it, what the motivations are. Is just exemplary of why people do it.
You know, like you touched on, you know, going into schools and educating, because, you know, no one's taught that at that level, and it does, you know, and that's another reason why I kind of wanted to get into this industry. I mean, the stuff I learned, you know, doing my studies to be, you know, qualified, was like, why doesn't everyone know this? You know what I mean?
It's amazing,
like,
isn't it? Yeah.
You know, an SVR, you know, standard variable rate. You know, I had a client 3 weeks ago. I was like, so when, you know, he's looking to buy a new property. I was like, when's your current product up? He was like, oh, it was up in January. I'm like, 5 minutes, and I literally switched his product, and I worked out it's like £1,500 I saved him over 6 months. Before, you know, when he sells his property eventually.
Yeah.
It's just little things like that, and you know, I think I fell victim to that myself with my mortgage broker. You know, he wasn't proactive. He didn't contact me prior to, you know, going up. And I suppose, you know, lives get so busy. You're like, oh, my mortgage just payments. You know, even if you look at your bank accounts, you know, some people don't even, you know, look at their bank accounts. But you know, you don't maybe realise it's, you know, £200 has come out that it didn't last long.
Yeah,
and it's because of the standard variable.
I've done it in my life with a property. It just went onto it for about 4 months. I just didn't realise. I was paying about £180 a month more, and just didn't realise, because life is busy and you're doing this, you're doing that. You know, you work, you're under pressure for here, that, and the other, and I just didn't realise it had happened. And yeah, it's easily done. And I think that's the difference between where you're actually talking to a proper mortgage advisor that's going to be proactive and work with you is really important. And we often talk on this podcast, don't we, about the right power team and having the right broker that you click with, the communication channel in this day and age as well. He needs to be, you know, really punctual, WhatsApp, however you want to talk, email, whatever it may be, but just in a much more modern way. And I think there's a new generation of landlords clearly coming to the market. And the older generation, I don't mean by age, but historic landlords that have been in the game for, you know, 20, 30 odd years, they seem to be the ones that are potentially selling up now and actually calling it a day. Maybe legislation's got a bit tricky for them, maybe the stress test and whatever it may be. There's reasons why they're gearing for retirement and things like that. And they're just thinking, let's cash in on the asset now. And there's this new batch of people coming through, which I think there's a lot of people that listen to this podcast actually are probably that group of people, but very interesting. Without putting you on the spot, but just talking roughly on numbers, what's kind of a typical good 75% loan to value buy-to-let product that's on the market at the moment for just a standard kind of freehold purchase?
Yeah, I mean, January sub 1%. You know, it's gone up quite a bit since then. Obviously, with the Bank of England increasing three times since then.
Yeah.
2 or 3 times. So you're looking anywhere between 2.2 and 2.5. But again, it depends on the situation. So the actual applicant. So for a first-time buyer, first-time landlord, their criteria is different. The lender will be different. So you're looking a bit more for that sort of that applicant.
Mm-hmm.
Whereas your kind of standard, like you said, you're looking pushing 2.5.
And it's a bit more for a first-time landlord, just because the lender doesn't have the same level of confidence in them.
So yeah, I mean, lenders. I mean, I always say to the clients, lenders will always look at the applicants as how risky are they?
Yeah.
Are they able to afford to pay me back, or what's the likelihood we're going to have to repossess this property? So if it's slightly more of a risk for the client, the interest rate will be higher.
Mm-hmm.
In that sense. Also, if it's a niche product, so first-time borrower, first-time buyer, there's not a lot of lenders that do that.
Mm-hmm.
So the actual market is reduced.
Yeah.
So not everyone's doing it. So
Yeah.
there's not a lot of competition for it. So they've only got 3 or 4 different lenders they could go to.
Interesting stuff. And I guess that those early twos, when you put that into perspective, some people have had some good luck, haven't they, over the last 24 months? But as long as we've been doing it, that's a really decent rate, to be fair.
Yeah, absolutely. I mean, I last remortgaged one of my buy-to-lets about 4 years ago, just under 2.5. So we're now back to 2.5. So we're at square one. And as you say, in the meantime, a few people have had an absolute bonanza.
Yeah.
Where they've been able to lock their mortgage rates at 1 to 1.5%, and fair play to them. But a 2.5% mortgage rate on an interest-only mortgage, when you're paying 25% plus as your deposit, means you cannot fail but make a profit on your buy-to-let property. Yeah. There is no way it can't function in that way. So there's still a long way to go with interest rates until it means that it's difficult for landlords.
Interesting stuff.
Cool. So going on to quickfire then, this is where an opportunity for you to take off your business sort of hat and give your personal opinion on where you see things. So no pressure. But the first one is, what happens next in the property market?
I guess your standard answer is, no one can see in the future. So, no one saw the crash in 2008, 2009, apart from a few people, if you've seen the films.
Great film, may I add.
It's a great film. But, it's very difficult. I can see personally that the interest rate will continue to increase, maybe another 2 or 3 times, to try and curb inflation. I mean, I can see the cost of borrowing getting a bit more expensive.
And do you think that will negatively impact the market, or do you think that will just level it off?
I think it should level it off, certainly.
Yeah, okay.
And I understand you're already a landlord today, but if you was to invest in another buy-to-let deal, what does that perfect deal look like to you?
In what sense?
So if you was to invest in a property tomorrow, your next buy-to-let, what does that look like to you? So would it be a HMO? Would it be a family home?
Oh, okay, good.
Would you be looking for cash flow?
Good question. Probably a HMO. Because someone pointed this out to me the other day and I was like, why didn't I see that? You're spreading your risk. If you've got one buy-to-let, for instance, that's one payment. If your tenant fails to make that payment, that's it. That's your one kind of income. Whereas if you've got HMO where you've got maybe, 6 to 9 people paying you money, if one, fails to make that payment, you've still got the other 8 or the other 5. So it's less riskier, in my opinion, for HMO.
That's a great outlook on it.
It's fascinating way of spinning it. Because people look at it as risk of, people are moving in and out, people might care about it, people might not look after it. But from a financial point of view, you're betting on 6 horses rather than the favourite.
Yeah.
Mm. Eggs in the basket.
Yeah, especially going through the COVID, when people did struggle to potentially make payments to landlords and things like that. So who knows if something like that ever is going to happen again. But it's a less riskier view on things, in my opinion.
I think the average HMO, let's say if it's got 6 rooms, hits base level cost at about 3 tenants, about 50% occupancy. So it's a great point to say, if you've got 5 in there, 1 void and 1 doesn't pay, and you've got 4, you're still up. But if you've got 1 tenant in your 3-bed property that's the earner, and they've been made redundant and they can't pay, well, you're in trouble.
Yeah.
It doesn't happen every day, but it often, if you were talking to a community of investors, the HMO would seem like the more risky investment. But when you flip it in that way, which I haven't heard said before actually, is quite an interesting way of looking at it as being more secure.
It's definitely the first time I've heard that. But then if you do a standard of like pizza HMO on steroids, it's quite a high occupancy rate and a nice long-term let as well. So you could be winning if you have full occupancy.
Of course,
very definitely.
Yeah.
And that brings me on to my final question then. If you can give the best single piece of advice to a first-time landlord, what would that be?
Sounds like you might have done it yesterday.
Best single piece of advice is to obviously make sure you have the best mortgage broker, myself. But aside from that, it is getting the right people around you, to help you make those decisions. So it is getting a good mortgage advisor. It is getting a good estate agent, a good set of solicitors that can do all the conveyancing. So those three players in that will educate that person in what to actually do.
It's consultancy, isn't it? And we've mentioned it so many times that if you pay a little bit more for the right person, you're not paying for that transaction. You're not paying you to do a mortgage transaction. When you look at it as a single entity, you're paying for the advice, the experience, the knowledge to be shared with you that you're going to use for the rest of your life. And that's why I think schools, we mentioned schools. I'm lucky enough that I'm actually going into a school next month in Crowthorne to teach. I think I've got about 25 minutes, half an hour to teach 16-year-olds property in half an hour. So it's going to be hectic, but they should know more about that. The curriculum should bring that type of life skill in. And I've said to the head of the sixth form, they should get an accountant in. They should get a mortgage advisor in. They should teach people mortgages. They should teach people how to start a business. They should teach people this in school, because I wasn't thinking about that. I got straight into my job first time round. And what's the first thing you do when you get a bit of cash? You buy a nice car. What does the car do the next day? It goes down in value. And that's the first thing we've all done, especially as, sort of young guys, as we would have been coming out of school. You want to show off your car, don't you? It's one of the first things you do. So, I think a really valid point, and it's been great having you on. So I appreciate you coming on, Tony. Thank you for your insight and your sort of honest view on things as well. And hopefully the listeners have enjoyed the conversation. If people want to get in touch with you, we'll put all the details within the podcast and stuff like that. What's the best communication for you? Mobile, email? WhatsApp?
Yeah, mobile, WhatsApp, FaceTime, Skype, whatever medium you want. Zoom, Google Hangout.
Everything and anything.
Everything,
Yeah, love that. Thank you for your time.
No problem at all, thank you.
So chaps, Tony's gone. What a great episode. Covering a lot, like you said, the cost of living, how things are changing and where the mortgage world is going. But coming over to you, Mike, what did you take away from that?
I'm pleased to hear that he's managing to get mortgages for people to buy to let when they're not a homeowner already. It's always been a massive bugbear of mine. You might have listened, you might have heard that, you might have heard my relief and my absolute joy that someone's managed to get one of those mortgages through, that some lenders are actually listening and thinking this is actually a good idea, because a lot of deposits going down is a very profitable thing to do, and it's a good idea, and the history of being a landlord is totally irrelevant to that.
Yeah, absolutely.
What about yourself?
Yeah, I enjoyed I wanted to just have a general conversation. We've had some mortgage advisors on and we've gone down specific routes of the industry, but just a general chat with a mortgage advisor, all things mortgages and market related. And it's good from Tony's perspective just to get that. I think he's confident, but he's also realistic. There was no forced sale in the market. And sometimes when you sit there and someone says overconfidently, we expect X, Y, and Z to happen, you have to sort of just sit back a little bit. But he was very forthcoming in how he felt things would be. He's very confident that interest rates are going to climb again from a base rate point of view, which I think is a logical explanation to what might happen off the back of inflation. And I think it was just interesting to get his perspective on things. But one thing that stood out to me, you always get a golden nugget thing that just sits in the back of your mind, and it was that HMO conversation sort of just over halfway, whereas he felt the HMO was the more secure asset to purchase because you're putting 6 eggs in a basket, and if one of them breaks, you've still got 5. Whereas if you've just got the single paying tenant in a rental and they can't, then you're kind of in trouble. So it changed my perspective of a HMO very quickly.
Something we learned last week on a course: your perception is your reality.
Yeah.
Right, and that's something that was drilled into us over 2 days. This course, nothing to do with property, all about mental health. Your perception is your reality.
Yeah.
Our perception about HMO, personally, is that it's risky because it's the high return, high risk end of the market.
Yeah.
His perception is I'm spreading my risk across 4 or 5 different people. So his reality is that's lower risk because he's looking purely on the spreadsheet of it, which is fascinating.
Yeah, and I think when we're talking on the Peter Lickerinas podcast about HMOs, you can see the passion and the confidence that he's got in them. When you do them right, you look after your tenants, you set them up so they look fantastic, like a boutique hotel, then the occupancy rate in one of his was 24 months, and still going, full occupancy. So maybe it's time that actually the perception and the reality of HMOs is articulated a little bit better, and there's a bit more tuition going into that on the average landlord, really. What about yourself, Tristan?
Yeah, I think it depends on, going back to the HMO, it depends on the way you look at it. Like you said, many other people would be scared to go into the HMO route, and clearly his perspective on that was totally different from that. I think it was good to have a catch-up overall. You've both mentioned both the things that stood out to me, but in particular just knowing what's going on within the marketplace as a landlord himself as well, and what he would look to invest if he was to buy a deal. The HMO was the one thing that I took out of that for definite as well. But yeah, great episode, lots of stuff to take away from that, and I'm sure the listeners that are listening in as well are taking a lot away. But as ever, if they have any questions for myself, Ian or Mike or Tony, then reach out to us on socials, which is at the Landlord Page. Until next time, guys.
Yeah, see you next Friday. I'm flicking through YouTube and through Spotify. I don't think there's a podcast or a video channel on YouTube that landlords could land on where they're not being sold something.
I mean, it'd be the first time any estate agents ever asked that question, but why not ask that question to a wider audience?
Estate agents have the knowledge there, but they don't seem to share it.
You can do different episodes based around someone that wants an exit plan or someone that's just starting their portfolio.
The rules change every year.
Yeah.
But why not just open the floor out and just say, well, is property even the best investment out there?
And tax advice is a big thing, especially with everything that's changed, capital gains tax, and obviously your stamp duty costs that you need to pay and whatnot. People don't realise what they need to prepare for.
We build a podcast and we build a YouTube channel, somewhere that landlords can go and they feel they're not being sold to, but they're just getting quality advice.